Hey, good morning. This is Jim Harvey, president of Opus 111 Group. And today I want to talk about something that we kind of all know is happening, and that is the frequency with which people change jobs, and more importantly, what you should consider doing with respect to your benefits when you do change jobs. But before we get into that, I try to do a little research into the data around job change. And as it turns out, it's not exactly specific. The Bureau of Labor Statistics does not track job changes during a particular person's career. So you're really left to some internet sources and the like. And I came across one called Zippia. And so I'll quote a couple of these statistics, but we do kind of know that my parents' generation, of course, they stuck with a job for 30 years and retired and had a pension. That's less the case. And as you get younger and younger, job change frequency is way up. They estimated, this outfit, Zippia, estimated that 37% of the U.S. labor force changed jobs or lost their job in 2020. Not surprisingly, that was the COVID-19 pandemic. They estimate that the average American will have 12 jobs during their lifetime, and that the average tenure is about 4.1 years with a single employer. And right now they're estimating that 65% of Americans are actively looking for a new full-time job. They also said that the average person spends just shy of 100,000 hours at work throughout their lifetime, which means roughly about a third of your life is spent at work. So the real question then is, with all of this job change frequency going on, what can one do? Well, let's just talk about that. So if you're changing jobs, you probably have a lot on your mind as you wrap up work with your previous employer and prepare for your new role. It can be easy to let important benefits-related decisions fall by the wayside. And if that happens, you could miss a lot of a limited opportunity to sign up for new benefits or miss out on making wise changes to your plans. So to stay on track financially during a career transition, be sure to review the status of your retirement accounts and other valuable employee benefits. So qualified retirement plans. Most employers offer qualified retirement plans, such as 401k plans or 403b if you work for a government agency or a university. Now, when you transition to a new job, you're entitled to keep the vested balance in your qualified retirement plan, including contributions and earnings. You're also entitled to keep any employer contributions that have vested to your employer's schedule. What can you do with the money? Well, you have several options. You can leave the funds in your current employer's plan if your vested balance is over $5,000. If the balance is less than $5,000, the plan could require that you roll over or distribute your assets. That's one. Second option is you can roll over the funds to an individual retirement account, or even into your new employer's plan. Most plans would welcome assets from a previous plan. The third option is to withdraw the funds and pay any taxes due along with applicable penalties. It's wise to carefully consider doing that before you do that. So potential penalties and fees. It's also important to consider the possibility of premature distribution penalties, as well as any fees and expenses a new plan may impose. So if you've separated from service in the year you turn 55 or any later age, any assets distributed from your old employer's plan aren't subject to the standard 10% penalty. Once the funds are rolled into an IRA or a new plan, however, the 10% penalty may apply to subsequent distributions if you're younger than 59 and a half at the time that you make a distribution, unless you claim an exemption. So, rolling funds to an IRA. So, factors to consider before taking the action to roll your funds from your, say, 401k or 403b into an IRA. The advantages is that IRA may provide more investment choices than employer plans, and that's almost certain. Most IRAs have a huge array of choices that you can do as opposed to the somewhat limited array that is typical of 401k and 403b plans. IRA assets can be allocated to different IRAs. So there's no limit on how many direct transfers you can make out of your IRAs to another IRA in a year. This means you can easily move money between IRAs if you're dissatisfied with an account's performance or administration. Although 401k distribution options depend on the plan terms, IRAs offer more flexibility, and then IRAs have more premature penalty exceptions than 401k plans. So the disadvantages: when you turn 72, you must start taking required minimum distributions from pre-tax IRAs, whereas you may be able to defer them in a 401k until the year you retire if your employer allows for it. Just a note, there are no RMDs required from Roth IRAs during the account owner's lifetime. IRA account expenses such as trading charges or annual fees may be higher than qualified retirement plans. And in fact, that's a pretty good bet. When you roll funds from a 401k to a Roth IRA, taxes will need to be paid on the pre-tax contributions. However, any future distributions from the Roth may be tax-free if the IRS requirements are met. Now, the other fund or choice that you have is rolling funds over to your new employer's plan. So employer plans offer the following advantages. If you intend to work beyond age 72, participation in the employer's qualified plan means that you can typically delay your first RMD until the year you retire if the plan allows. An exception applies if you own 5% or more of the business offering the plan. Employer 401k plans may receive greater creditor protection than IRAs. Typically, employer plan funds cannot be used to satisfy most creditors, while the federal protection for IRA funds is more limited. Stock options and non-qualified deferred comp plans. Prepare a list of any stock options you've received from your employer. Often vested options expire within a specific time frame when you leave a job. Deciding whether to exercise your option depends on your financial situation and whether your options are in the money, that is to say, exercise price is lower than the market value. Non-qualified deferred comp plans allow executives to defer a portion of their compensation and the associated taxes until the deferred income is paid. With these plans, leaving your employment may trigger the need to take distributions in lump sum or installment payments. You should be aware that any distributions will affect your taxable income. Life insurance and disability insurance are typically other benefits that you may have through work. Employer-provided life insurance remains active only while you're employed. Ask if you have the option to convert the policy to an individual policy offered by the same insurance provider. Often they will allow that. If you do switch to an individual policy, however, the premium will likely increase. In some cases, it may be time to evaluate policy options from other companies. If you're in between jobs, for instance, you may want to consider an individual policy that won't be affected by employment changes. Health insurance. Obviously, your health insurance will expire once you leave an employer. COBRA may be a good option if you need interim health insurance coverage. Keep in mind, however, that your premium payments will increase when you opt for COBRA coverage. Shopping for individual health insurance policy means your needs could reduce your premiums. It's also important to know that COBRA is not universally applied. If you're leaving a small company, like for example mine, by law we cannot provide COBRA coverages, which means that your health insurance you can choose to pay it, but only for 3 months. Under COBRA, I think it's 18. Finally, consider a new benefits review. Once you start your new job, take time to understand the new benefit options, including health insurance, disability insurance, and employer savings plans. It's important to review how the new employer retirement plan options fit into your overall savings plan, including any employer matches. Remember to fill out beneficiary designations for insurance policies and savings plans, and review those designations periodically. Finally, if your salary has changed, it's a good time to determine whether you should adjust your tax withholding and investment elections. So, in sum, often we tend to ignore all these benefit decisions and policies and premiums that we may be involved in when we change a job, because all you're really focusing on is, what am I doing every day? How much am I getting paid? But these other parts of that decision often go unexamined. And we strongly suggest that you also take a look at that, not only when you're considering leaving a job, but when you're considering to take a new one, and find out what the differences are between your new employer and your old employer and how that affects you and your financial life. This is Jim Harvey, president of Opus 111 Group, and this has been Your Money Week. If you'd like to learn more, we invite you to go to our website, opus111group.com. Go to the Learn page, where you will find written blogs, audio and video blogs like this that hopefully can make you a more informed and more comfortable investor as you move through your financial life.